ETFs, index funds, or mutual funds? A long time debate in investing. Let's look into what you should be investing in, how each of these categories work, and what each of these terms mean. These are all stock funds, different categories of stock funds. Stock funds hold thousands of stocks or tens of stocks or just a few stocks. They hold any number of stocks, and they can have instructions that say they'll only invest in a certain industry or a certain sector. They'll only invest in a certain country or a certain type of investing, like value investing or growth investing. These are all contained inside these different categories, stock funds. ETFs are traded just like stocks are. They have a ticker, they trade in market hours, and they trade on any exchange. That's what they're called, exchange traded funds. Mutual funds trade on a much older, much more archaic system. They have one price at 5 p.m. or 6 p.m. depending on the time zone. They trade one price per day. And you have to place an order a couple of days before it's actually going to happen, because it runs through the system of processing everybody's orders and putting them through at the same time. You don't have to sit on your computer at 5 p.m. and hit your order right at the right time. It's not anything stressful like that, but it is slower than an ETF system, because an ETF system you can trade anytime throughout the day as you would with a stock, not in the nighttime obviously, but in terms of market hours or any sort of trading time. And you'll get your investment instantly. You'll know what price you're going to pay for it. You'll know whether your order's gone through or whether there's been any problems within a couple of seconds. ETFs are much faster. The other difference with mutual funds is their expense ratio, their costs. I'm beginning to sound a little bit biased, but that's because, to me, mutual funds don't make much sense. They might make sense if you're looking for an actively managed fund and you're looking for a very specific type of fund, but those types of funds are usually more expensive, and you might wonder why more expensive funds are using a more archaic system. It might just be because people are stuck keeping on investing with those funds and keeping on investing with that system because they've been investing with it for years. ETFs are a much more modern, much newer system. They've only been around for maybe the last 20 years, maybe even less for a lot of big ETFs. They're only sort of 5-10 years, a lot of them. Some of the ones that I've seen are only a couple of years old. Now that might say to you that they don't have a long track record, but with a lot of the ETFs that you're investing in, you're not investing based on track record because you're not looking for an active manager. You're looking for, they invest in the top companies in the electric energy sector or something. But with mutual funds, you might be looking for a very specific subsector, which they might provide for you, but they'll cost an extra premium. And any research that's been done into the difference between actively managed funds and funds that don't have an active manager or an active human element in them shows that generally they're either riskier, more volatile, or they just don't meet the same level of performance that the market does already. There is something to be said about the main reasoning behind investing in an active managed team and an active managed fund, which is generally, if you're going to try and pick stocks yourself, you're going to be better off choosing an active manager. Somebody who has skill and experience in picking stocks, they're going to be better than you are at it, probably. I don't mean that with any offense. They're going to be better than I am. I couldn't pick stocks. I class myself as just as much of an average investor as anybody else, because I don't want to put much time or effort into researching companies, and I think that it's very risky to do so. But other than their archaic system, there aren't a ton of differences between mutual funds and ETFs. ETFs include a lot of the same types of funds that mutual funds do. Mutual funds include a lot of the same types of funds that ETFs do. It's purely just their trading system, their costs. On average, mutual funds cost about 1%, whereas on average, ETFs cost 0.5%. Some of them cost as low as 0.1, 0.05%, which makes a big difference. As you can see on the screen here, over 50 years, 5.93% per year, which is the average if you had an S&P 500 fund and you were investing 0.07%, there was a 0.07% cost. If you take off that extra 0.93%, you go down to 5%. These are the two figures you get. If you're going with 5.93% a year, you're getting pretty much $500,000 over 50 years. If you're going with 5% per year with that extra cost, and that's your average, you're getting $324,000 over 50 years. That's not very good. Even if an active manager will promise you, oh, we're going to get 10% returns, we're going to get 15% returns, they don't know that. There's nothing that says that they're going to perform better than anybody else does. They're often just very volatile, and they just take more risks. They just gamble more with the stocks that they pick. Or they're investing in less stocks, and they're just having less diversification, which means that they'll have better years when they have good years, and they'll have worse years when they have bad years. This is part of the problem with any sort of active fund, is that it's impossible to tell when a good year is going to happen. It's impossible to tell when momentum will happen for a fund, because they don't, past returns really don't reflect future expectations. A fund that's been doing well for 10 years has the same chance of doing well the next year as any other fund, and the same chance of doing badly. That sort of momentum doesn't really exist in the stock market, when anything can happen to a company, anything can happen to the market. A pandemic like the coronavirus can come in, and then suddenly, if you're one of these active managed funds and you decide to pull your money out of the market or something, suddenly you've missed out on a huge bull run because the tech market has just decided to explode. These types of things are not predictable. Even if you're an active manager who has lots of skill and lots of experience, nobody would have predicted anything that was happening last year, and nobody would predict many of the things that have happened in the stock market. This is just a natural thing that humans can't really predict what millions of other humans are going to do. And if they could, if somebody could actually predict how well companies would perform, why would they let anybody else have that skill? Why would they sell that off to anybody else for 1% of their fund? Surely they would just keep the money themselves and get rich themselves. Just something to think about. If someone was really that skilled, they probably would just invest for themselves. Index funds is the other category, the third category that's included in both of these. It gets included in the same conversations, and it's in the same comparison here because index funds are sort of a standout of the other two categories, and some people think they're a separate category altogether, and there's indices themselves that don't have the funds, which are a separate category that are used on the news and everything. But basically, index funds are set on an index. So like the S&P 500 or the Nikkei 225 or the FTSE 100. These are indexes that are used just generally throughout the stock market and throughout the economy for different reasons other than just investing in, but these are funds that are based on those indexes. So for example, the S&P 500 is the top 500 companies in America. The Nikkei 225 is the top 225 companies in Japan, and the FTSE 100 is the top 100 companies in the UK. This is a general theme, is that if there's a thing like a FTSE or an S&P or Nikkei, that's usually a company or a word or something that describes where it's from, and then there's a number that tells you how many companies are inside that. There's also things like the Russell 3000, and there's lots of different indexes for lots of different places and lots of different things. And this is where index funds, they're set to those instructions. The fund doesn't make any decisions. The companies that decide the indexes do, and often those are separate companies, which means that it's all just based on the market and an average of a section of the market. Like you could have an index fund that was just investing in companies in a certain sector, rather than having an active manager trying to pick the companies out of the sector. That's kind of the difference, is that you'll have consistency and confirmed, you know what you're investing in. It doesn't change a lot. There's no trading fees that are happening because trading is generally low. The S&P 500 usually trades in single figures per year, so only a few percent of the companies come in and out of the S&P 500 every year. It's generally the same companies that stay at the top. So that's why that's a cheaper thing for the index funds compared to the active managed funds. Some active managed funds are swapping companies in and out all the time, and that has costs in itself that affect the performance of a fund. Index funds are just nice, easy, no decision investments. I'm very biased towards index funds because I invest in index funds myself. And I'm biased and I invest them myself because anytime in the past that I've had experiences with investing and any time that I've researched about index funds, it seems to just make the most sense. Maybe you can get ahead with picking stocks if you have crazy talent like Warren Buffett, or if you're willing to spend 12 hours a day looking through stock manuals and looking through company information and analyzing the whole marketplace of a certain tech company that's about to explode or something. But a random hunch is not going to tell you when a company is going to explode. And so that's where, for me, index funds is a nice way that I just keep my investments consistent and secure. I'm investing in all of the companies. For me, I invest in global index funds that are based on indexes that invest in the whole world's stock market. There are 3,400 companies in the index fund I invest in. It's just about consistency and collecting all of those companies into one basket so that I don't have to make any decisions. Now, I'm not completely superhuman on this, and it's an easy way to say that you're disciplined and consistent with this, but a good way that helps me stay consistent with this without feeling like I'm missing out on companies is I have a small bit of money in a separate account that I use to invest in specific companies that I think are either going to do well for whatever reason, or there's a news story, or just for more of a game type feel to the stock market. And that can be a good way to get experience with investing in a different way and to get that emotional feeling. Because if my bigger portfolio that is 30 times the size of my tiny little separate account, if that does anything, it doesn't bother me because I didn't make any decisions. I'm not to blame for it. If my tiny little account, if I'm investing in a company because I've seen somebody on Twitter say it and I just go, okay, I'll throw £15 into that, or if I invest into a company because I see that they've had some sort of production line problem, but I still think that even though that's a bad news story, I still think the company is going to do well over the next however many months. If these sorts of things go well, then great, I didn't miss out. If they go badly, then I can see, and often they do go badly, I can see, oh yeah, investing in single companies is a roller coaster. It reminds me that. This is something I recommend to people as well because it gives you something where this is a small amount of money that you can feel much more relaxed about, but you still will feel the emotions like it's a big amount of money. Because if you make a good decision or a bad decision, that alone matters to your brain more than the actual size of the decision a lot of the time. The other big reason I like investing in index funds is because I'm investing in millions of employees across lots of different companies. If you're investing in one or two companies, you're just investing in less people. And to me, the more people you're investing in, the more chance that those people are going to push forward and figure out a new technology or figure out how to profit off of a new system, or that are going to survive a crash like the coronavirus or something. The chances that 1,000 people are going to survive the coronavirus crash, for example, and I'm not meaning in terms of actually dying from the disease, I just mean in terms of a company that is employing 1,000 people. The chance of that company surviving is a lot smaller than 5 million employees or 100 million employees. I don't know how many employees are actually covered in the 3,400 companies that I invest in, but I'm sure it's a lot. This is a little different thought for me. It's just the people that you're investing in increases when you're investing in index funds. Hopefully that's explained each of these different types of investing. Hopefully that's explained the different versions of stock funds that you can get and where you can get them. If you're looking for a mutual fund, it's likely to be on specific brokerage platforms or on a computer system platform. If you're looking for just any sort of stock fund, or if you're looking through your brokerage app on your phone, like a no commission brokerage app like Robinhood or Free Trade or these sorts of apps, then you're going to be looking for ETFs and you're going to be investing through that. Okay, hopefully that helps. Good luck with investing. I've been John Williamson. Thank you very much for watching. Subscribe down below. Cheers.